Hello, I'm Stephen Malinak, head of the team that creates the StarMine models. Our quant models provide users with value in many different ways. In this video, I'll cover 3 sample workflows: screening, drill down, and risk analysis. Screening is one of the most straightforward applications of StarMine models. To find the screener from anywhere in Eikon, just type equity screener into the Eikon answer search bar. StarMine models score stocks from 1 to 100, with 1 being the most bearish signal and 100 being the most bullish signal. Here's a sample screen that looks for small cap companies in the US with a Valmo score over 80 and earnings quality score over 70. It's easy to create more complex screens from drawing upon thousands of different factors to match just about any investment strategy. Fundamental portfolio managers use screens for idea generation and to guide in-depth investigation. Building screens helps portfolio managers save time by focusing their research on a much narrower universe of stocks. Screening is also a good way to generate a watch list. StarMine models can just as easily be used to create screens to search for shorting ideas. Here's a list of stocks with Valmo less than 20 and earnings quality less than 30. One long-standing benefit of StarMine models is their clear box nature. Say you heard about a stock on Alpha Now, perhaps Pilgrim's Pride from this quarter's predicted earnings surprises. Let's start with the scores on the StarMine Models widget. If you don't have this widget installed, please see the video explaining how to install it. The URL is at the bottom of the screen. At the moment, the analyst revisions model is giving the most bullish signal at 98 out of 100. This number summarizes recent changes in analyst opinion across many different measures. Just click the score to examine the underlying detail. First, look at the chart and notice how the stock price falls when the analysts revise down and rallies when the analysts revise up. Next, see how every measure in each fiscal period has been revised up recently. This is what we call a sea of green, a very bullish indication for the analyst revisions model. Smart estimates help to predict future earnings revisions by placing more weight on recent forecasts by top-rated analysts. Notice how the smart estimate in orange is leading the consensus in blue upwards. The predicted surprise is the percent difference between the mean and the smart estimate. Click the predicted surprise for this year's earnings to see the underlying analyst detail driving the smart estimate calculation. Here you can also see a bold estimate from a 5-star analyst. When one of the historically most accurate analysts on a company really sticks his neck out with an estimate 5% or more away from the consensus, we highlight that and call it a bold estimate. You can then drill down to see his accuracy scorecard and his current opinions if you'd like. Here's another interesting use case from my travels around the world. With interest rates so low these days, many people are chasing dividend yield as a source of income. In some cases, high dividend yields are not sustainable. How can StarMine help you identify which high-yield companies are the riskiest? Let's build a screen to find out. Here are all the companies in South Africa with a market cap over 1 billion US and a dividend yield over 5%. Now click the first one, African Bank Investments Limited, or Apple. As we scroll through the page, we see a few troubling things. All the StarMine scores under quality and credit are red, and most of them are bright red. Scrolling down further, we see a headline under news and research that says, Dividend Shocker. For a regular user of StarMine models and Eikon, this would not be a surprise. Let's see why. Going back up to the credit risk scores, click text mining to see what we can find out about what's going on in our news feed. Let's look at this news update from May 20th. Here we see a 70% dividend cut and talk of a potential bubble now materializing with cold hard numbers. Take a look at the structural credit risk charts and credit views. We can see StarMine has Apple in the bottom 2% of its industry, and the score fell precipitously in early May, 2 weeks before the dividend cut. In summary, StarMine models help you narrow the focus of your research, drill down into underlying value drivers, and stay on top of important risk factors. For Thomson Reuters, I'm Stephen Malinak.